Hello and welcome to the latest Expert Series webinar. Today's presentation is Factoring the Importance of Dividend Growth. This is a complimentary ETF.com webinar courtesy of ProShares. I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today are Raina Oberoi of MSCI and Simeon Hyman of ProShares. Raina has been in the investment industry for a decade and has held several roles, including that of an index trading strategist. She now focuses on research and working closely with clients, that's asset owners, managers, brokers, investment consultants, to see that their needs are met as clients of MSCI. Simeon Hyman joined ProShares last year. He is the head of investment strategy. He heads ProShares' team of investment professionals. They are engaged in portfolio analysis, product research and development, education, and investment strategies using the company's growing family of alternative ETFs. I may ask a question or two along the way as Raina and Simeon make their presentation, but I'd like everyone to know there will be a Q&A session at the end that I'll moderate. All of you can ask questions at any time during the webinar in the window at the lower right of your screens. And remember, as we go into this, that the presentation and the deck will be available to all of you 24 to 48 hours following today's webinar. Dividend-focused investing has been all the rage over the past few years as investors look to diversify sources of capital appreciation and income in the aftermath of the 2008 and 2009 market downturn. Now, one pocket of dividend-focused investing that does merit a closer look is the isolation of companies that have consistent track records increasing dividends. These types of strategies are really evergreen in the sense that the index methodology around which they are designed is meant to deliver total return over time. So this is less about dividends as a fad and a lot more about long-term, thoughtful asset allocation. Think of this as a dividend-growing strategy as owning not a blue chip that has a rich history of both capital appreciation and dividend increases, but it's rather an entire diversified portfolio of many blue chips with this characteristic of dependable dividend growth and capital growth. MSCI designed the Dividend Masters family that this dividend growth strategy is based on, and Raina Oberoi is here to explain it, the MSCI indexes, and to answer any questions you may have about this approach. Now, these are investable indexes, and ProShares' Simeon Hyman is here to talk about two funds that his firm sponsors that employ this dividend growers approach. The two securities are the ProShares MSCI EAFE Dividend Growers ETF. It trades under the symbol EFAD. It launched last month, and the index and the ETF are an equally weighted riff on the MSCI EAFE index that canvasses the developed market of equities. It isolates companies that have raised their dividends for at least 10 years, and it has almost $4 million in assets. Also, we'll talk about the ProShares S&P 500 Aristocrats ETF, which trades with the ticker NOBL. It came to market last October, and it has assets of almost $250 million now. It's also an equally weighted version of the S&P 500 in this case, and it screens for constituents of the S&P 500 that have raised their dividends for at least 25 years. So enough for me. Let's hear from Simeon Hyman of ProShares and Raina Oberoi of MSCI. Raina, you're first. Take it away.
Thanks, Ollie. Hi, everyone. I'm going to start by talking about MSCI's research and expertise in the factor investing space, and then go on to illustrate how MSCI's Dividend Masters Indexes capture the international dividend growth story. So as we all probably know, factor-based investing has become a widely discussed topic today. So what is a factor? It can be thought of as any characteristic relating to a group of securities that is important in explaining their risk and return. MSCI currently identifies 6 key premia factors, and we group them as pro-cyclical and defensive factors. So value, low size, and momentum are considered pro-cyclical, whereas low volatility, high yield, and quality are considered defensive. In the last few years, the development of the MSCI factor indexes has provided a very powerful way for investors to access these premia in a cost-effective and transparent way. Now, a point I would like to make here is that investors should note that factor indexes should not be viewed as replacements for market cap indexes. According to us, market cap weighted indexes are still the only reference for a truly passive, macro-consistent buy and hold investment strategy. So in contrast, investing in factors actually represents an active view, and this view is away from the market portfolio. So investors must form their own beliefs about what explains the premium and whether it's likely to persist. So the chart on the top right shows, it's a pretty good depiction of how the passive factor allocations combine attractive elements of both traditional passive and active mandates. So now let's move on to the main topic of today, which is the MSCI's Dividend Masters Indexes. So what is really the motivation behind the creation of these indexes? What we've seen, in our conversation with clients and just in general trends in the investment community is that increased demand for income from aging populations and the maturing defined benefit plans have triggered renewed interest in income investment strategies. So what our Dividend Masters Indexes do is really aim to reflect the performance of companies with a track record of consistently growing dividends. The traditional approach to dividend investing has been really to capture high dividend paying stocks. But the approach we have used for this specific index methodology is to capture the dividend growth story, which not only captures dividend income as a stream, but also provides long-term capital appreciation through dividend growth. So really for investors who are more forward-looking and wish to capture this future stream of capital appreciation, products such as our Dividend Masters play a crucial role. Also, traditionally what we've seen is that such a strategy has been very U.S. focused, and we've increasingly become aware from investors that they are extremely interested in harvesting the international dividend growth premium. And as a result, the Dividend Masters Indexes that we have launched on the MSCI EAFE Index and then the MSCI Emerging Markets Index are really one of a kind and truly capture the global dividend growth story. So I'm going to quickly, walk you through some of the methodology highlights of the Dividend Masters Index. And they're pretty much the same for both the EAFE Dividend Masters and the EM Dividend Masters, apart from a couple of differences. So the EAFE and the EM Dividend Masters are both based off of the parent standard index, which includes large and mid-cap stocks. And we do target a minimum number of securities, which is 40 securities in both cases, just to kind of give the index the capacity it needs, as well as to avoid any sort of concentration that might happen with a fewer number of securities. The EAFE Dividend Masters Index has a look-back period of 10 years. And what this really means is that companies included in this index have consistently increased dividends for 10 years. And for EM, we have a look-back period of 7 years. You must know that the index is equally weighted, and we also have country and sector cappings in place to avoid any concentration in the indexes. So just to sum up what we've discussed so far and what we will talk about in the next couple of slides is that there are really three key benefits or other features of the Dividend Masters Indexes. These companies are companies that provide sustainable dividend income, plus provide the opportunity for long-term capital appreciation. they have historically outperformed the parent indexes and do have the potential to outperform, especially in volatile times. And we'll see that in the next couple of slides. And also the way we construct these indexes, as we've already talked about, by our sector and country cappings, as well as targeting a minimum number of securities, we actually reduce concentration risk in these indexes. So here is just the latest snapshot of the indexes, so just to give you a sense of the names that are included. And, as you can see, there are companies from various countries across EAFE and EM. So this kind of just gives you some sort of a perspective, in case you're familiar with any of the names, that these are, in fact, the dividend growers in the international space. The two charts on this slide give you an idea of the performance of these indexes versus the parent, and you can clearly see the outperformance versus the parent. What's really striking here is that post-crisis in 2008, the Dividend Masters strategies perform even better in both cases, highlighting investor preferences for dividend and dividend growth strategies. The table on this slide gives you a deeper look into the return and risk characteristics of these indexes versus the parent. And these are numbers starting from 2002, and you can see that both strategies have performed better than the parent with a lower risk profile and do have a significantly higher Sharpe ratio as well. The slide just gives you a picture of what are the factors that this index is exposed to. And we've been able to do this, because of our expertise in the BARA space as well. And the factors that you see here are, in fact, the BARA factors. You see that these indexes have exhibited lower volatility across regions compared to the parent. And the indexes do have a smaller cap bias since all constituents are equally weighted. On this slide, we really see the sector exposures, and sector regimes too remain similar across regions. Sectors such as financials and information technology are underweighted compared to the parent, whereas sectors such as consumer staples and healthcare remain overweighted. So I'm going to end there, and if there's one thing I would really like you to take home is that, really these are the only indexes that capture the dividend growth story in the international arena through a passive, transparent, and rules-based strategy. So I'll pass it on to Simeon, who will talk about the ProShares product based on our indexes.
Raina, Simeon, this is Ollie Ludwig. If I can just interject one quick question before you take the floor, Simeon, is that all right with you?
Absolutely.
Thank you. By the way, I think at the beginning I said that this webinar was sponsored by ProShares, and in fact it's MSCI, so I stand corrected and I apologize. Raina, you talked about the overweighting in the consumer staples, and I'm wondering if you can characterize what the dividend methodology does in terms of a portfolio tilt, as far as what's the characteristic? How would you call that overweighting of consumer cyclicals? What does it tell an investor in the simplest terms about the kind of a portfolio we are looking at here?
Yeah, so it really shows that the consumer staples sector within EAFE as well as emerging markets are the companies that are consistently increasing their dividends over time. And that kind of goes to show their kind of consistency as well. That's why we'll see that this index also has a lower risk profile than the parent, because it is, capturing the consumer staples space a little more, because these are companies that have been consistently paying dividends over time and growing those dividends.
Thank you. Simeon, I'm sorry to have interrupted. Please carry on.
Thanks, Ollie. If I can, now I have the ball, I'll flip the slide. So we're really very excited to partner with MSCI on ticker EFAD, because as Raina noted, this focus on dividend growth has really been a U.S.-centric activity so far, and we've been very pleased with ticker NOBL, which I'll talk about briefly in a minute on the dividend growth side in the U.S. But it is indeed a factor, if that's the nomenclature you'd like to use, that we think has efficacy globally and has really the opportunity to deliver potential outperformance. And it's hard to make this story any more complicated than it is. It's really pretty straightforward. Following stocks that grow their dividends year in, year out is just a great shorthand, if you will, for a lot of things that sort of active stock pickers have done for years by hand. You look at the balance sheet, you look at the income statement, you do all this work, but when companies grow their dividends, they're telling you every year that their prospects are good, that their balance sheet is strong, because the last thing a company wants to do is cut its dividends. So companies, when they increase their dividend, are really giving you a very, very strong signal. To some extent, it's almost like the ultimate earnings surprise, if you want to think about it that way. And what we wanted to do as ProShares is we wanted to focus on ETFs on the strongest and most popular indexes, and also focus on those companies with the longest year-over-year dividend growth. So you heard Raina mention the 10-year requirement on EAFE and the 10-year requirement and the 7-year requirement on emerging markets. But it's that repeatability that I think is really, really important. And Ali, to your question earlier, where do you get some of these sector tilts? Look, these are high bars. As an example, as I'll flip the slide, and there's just the note of the tickers EAFE, D, and Noble. But I wanted to flip to this comparison of the bars for the EAFE Dividend Masters and the Dividend Aristocrats. So very high bars, 10 years and 25 in the U.S. We're not going to have a bank in the S&P 500 Dividend Aristocrat Index for probably about 20 years, because all those banks had to either cut or at least either eliminate or cut their dividend in the financial crisis. So some of that just comes from the nature of that very high bar, because what these indices really do is they tease out companies that literally are doing that sort of ultimate earnings surprise year in and year out. And as I mentioned, the dominant index in the international space, of course, is the EAFE index. So this really helps us offer globally on the most important indices for the various asset classes with that longest track record, and with the important overlays of equal weighting, caps for sector weighters and caps for country weights, that make sure that these indices are very well thought out, very balanced, and don't have any of the sort of unintended biases that you often see in dividend strategies. And one that I thought I would highlight, we mentioned that these strategies are quite evergreen. They really are not designed to be, particularly tactical bets. The dividend growth is a factor that can deliver outperformance in just about any market environment. But there is a tactical opportunity right now, because many individuals have tilted their portfolios towards high dividend yielding strategies as opposed to dividend growth strategies. And those strategies do have a particular tilt, which can have what you might call sort of cyclical overtones. And here I just wanted to highlight that utilities, as the poster child of a high dividend yielding sector, is a particularly interest rate sensitive part of the equity market. So you can see that last year, in the second half of the year, when Treasury yields went up about 50-odd basis points, that utilities substantially underperformed the S&P 500. But in the first half of this year, when, to some people's surprise, between geopolitical conflicts, slowdown in China, maybe a little buying of the long end of the curve by defined benefit plans, lots of reasons for this, but that drop in interest rates drove a dramatic outperformance of utilities. So again, it's sort of neither good nor bad, but what it tells you is, well, if you're thinking I might have enough interest rate risk in my bond portfolio at this stage of the game, maybe I don't need extra bond risk in my in the stock portion, the equity portion of my portfolio. So, we first and foremost want to emphasize the evergreen nature of these strategies, but there is always a current environment to take into account, and for those individuals who may have moved significantly towards high dividend yielding strategies, it might be worth thinking about the opportunity to rotate some of that towards the more balanced strategy of dividend growth. And finally, I'm really jumping slides there. In terms of asset allocation, once you take this approach of focusing on the dominant indices, the most common indices, the asset allocation story is very straightforward here. These are straightforward pieces of your equity portfolio. Noble in the U.S. fits right in that large cap sleeve. Again, depending on your conviction with regard to the factor, it can replace an index and can replace an active manager, but fits squarely in the core part of your U.S. large cap allocation. And of course, MSCI EAFE, which remains the go-to benchmark for international developed markets. Dividend Masters fits right squarely into that core piece of the international developed allocation. Again, most typically either taking the place of a market cap weighted passive strategy or an active strategy in either case. And with that, I'll hand it back to you, Alex.
Thank you, Simeon. I wanted to take up this asset allocation question straight away, which you were beginning to touch on there a moment ago, Simeon. Is there any compelling reason why someone couldn't take one of these strategies and as opposed to just part of the sleeve of large cap equity, just swap it in entirely? The slide that Raina served up there where we saw the outperformance, you'd think, why not, right? It didn't dive as deeply when the market fell apart 6 years ago, and then climbing out of that, it looks better than the mother index in both the cases that she laid out, which is EAFE and emerging markets. Can you put a little nuance on that asset allocation piece?
Sure. I mean, I think the answer to your question is yes. I mean, these are core strategies. They have, what I would call, and I think Raina would agree, is sort of a modest tracking error to their underlying market cap weighted benchmarks. And they don't exhibit, dividend growth strategies typically don't exhibit lots of cyclicality based on either the macroeconomy or the factors that Raina laid out. So, the odds of massive departures from your market cap weighted indices are not that large, and if anything, they tend to have a little bit of extra downside protection. So, you can absolutely swap your entire slices of these core equity pieces, either in the U.S. or international developed markets. But look, most people practically will not have sufficient faith, even in a balanced factor like dividend growth, to say, okay, that's going to be my entire allocation. So, that's really up to your individual level of conviction. But the vote for it is that it's not a narrow bet. It's not a narrow bet on high dividend yields that can have real interest rate cyclicality. It's not a huge bet on either value or anything like that can have real winning and losing cycles versus the underlying benchmark.
Right, and with regards to unintended biases in dividend strategies, you briefly touched on that relative to what you're calling here the evergreen strategy. Can you touch on some of these unintended biases? Maybe you were just beginning to touch on a couple of them just a moment ago, but if you could paint a little more broad brushstrokes there, what are people getting into in dividend strategies that they may not fully understand, for example?
I think to keep it from going off into a different topic area, the biggest one to contrast dividend growth to is high dividend yield, and that's where you're really picking up some material interest rate risk in your equity allocation, and what that means is you're sort of bringing in macroeconomic cyclicality, where the dividend growth strategy really just doesn't exhibit a lot of that. It exhibits a nice, modest asymmetry. In other words, its up capture is a little better than its down capture, but it doesn't materially change its relative performance either through the business cycle or with respect to any one individual factor. It's kind of what the academics would call sort of well-behaved.
Perfect, Raina. I don't want to leave you out in the cold there. With regards to the indexing methodologies, you both touched on the length of time to make it into these various dividend screens. We can leave the S&P off the table for a moment. That was at least 25 years, right, Hyman? Excuse me, Simeon?
No, 5 years.
25, at least 25, yeah. Now, with regards to the MSCI indexes that we have in focus here, Raina, 10 years at least for the EAFE and 7 years for the emerging markets, right? That's correct, right?
Yep.
Kind of drill down a little bit here. Why that time period? Why not longer for EAFE? I mean, we're talking developed markets, right?
Right. Yeah, so, I mean, we looked at different scenarios, and really at the end of the day, our goal was to balance the longest look-back period that we could get along with the breadth that the index offers. So, for example, for the EAFE, we did look at a 15-year scenario as well, and what happened there was the number of companies that were getting captured were coming down to about 20 securities. So that, to us, is a very highly concentrated index, and for us, in terms of index construction, just having that capacity and the lack of concentration within these indexes is key, because that eventually translates into how investable the index is. And especially if we have ETF products of these index, for example, the one we're talking about here, these products directly track the index. So in fact, the ETF issuer is, in this case, ProShares, is not really doing much. They're basically following the index methodology. So if the index as an underlying component is not investable, then that's going to be an issue for the ETF, and as a result, it's going to be an issue for the investor. So it's really kind of to balance out the breadth and the capacity of the index versus the time period that we wanted to capture. And so the 10-year period and the 7-year period for both EAFE and EM respectively turned out to be optimal.
And speak to the number of constituents that you talked about the EAFE there. If you blew it out to 15 years, you suddenly had 20 constituents, right? So now, what are you looking? How many in terms of number of constituents in the EAFE version of this, the Dividend Masters?
So we have approximately about 50, and we have a minimum requirement of 40. So they have to have, at any given point in time, there has to be at least 40 securities. And then, if they're more than that, that's great. But at this moment, we have about 50 securities.
And the rebalancing of the index occurs at what intervals?
So we have a quarterly rebalancing where the weights are set, reset, and then November is really the annual rebalancing where the entire universe is kind of reconstituted.
Right, the reconstitution, that was that better term, yeah. Okay,
yeah.
Okay, perfect. And then with regards to the emerging markets, if you might go down that same path you just did on EAFE, 7 years, do you have a constituent problem there as well that you had to be mindful of?
Yes, so we had a constituent problem there. In terms of, well, I would say in terms of the consistency of dividend growth, again, our number of constituents came down. And then, in emerging markets, you do run into more data issues as opposed to running into into EAFE. So really, given that our indexes are kind of the first index in the emerging market space, we've been able to capture the history as well as it possibly allows us to, and hopefully, going forward, we can capture a larger universe.
Right, and the emerging markets version, the mother index there would be the emerging markets, the MSCI Emerging Markets Index, right? The one everyone always talks about. Yeah, okay.
Yes.
And with regards to products, there are no products out there now based on this emerging markets variation, right?
No, not yet.
But a betting man, yeah. You said stay tuned. Is that what you said? Yeah, I was just going to say yes. A betting man would say probably going to happen if you're creating a whole index series on it. You mentioned, Simeon, a moment ago with regards to the S&P version, the NOBL security that you guys market, that there will not be any bank stocks for a long time. I mean, one could cook up an argument that that's a liability. That, you know, boy, these are perhaps they'll be the most rapid dividend growers of the next decade. You know, are there any other blind spots, or how would you defend that sort of attack that I'm cooking up over here?
Well, you know, I think that's why most investors would not place their entire asset class sleeve, their entire, in this case, U.S. large cap sleeve in dividend growers. So, you know, this is 50-odd stocks, and there's 54 in ticker NOBL, so similar to EAFE. You know, that is what I would call sort of a modestly concentrated that's a kind of a typical number that you might see an active manager have. So, yeah, this is a departure from your market cap weighted benchmark. The historical outperformance of these strategies, both in the U.S. and globally, is quite strong. The defensive nature is duly noted, as Raina indicated. But you're going to get some differences. And to the extent that you have a view that financials are going to take a run, then you're going to want to make duly noted that in your portfolio construction. But I think that's what sets these kind of strategies apart is their rules-based nature. If you cut your dividend 5 years ago, you're out for 20 more years. And, you know, that's what makes factor-based or smart beta what it is, that it follows that strategy and you know what it's going to get. There isn't discretion here. So I think you have to take account of it. You look at the track record, you look at the history, and you understand how it's going to perform, and you know that's what you're going to get going forward. But it is important for folks to take a look at that, take a look at those aspects of portfolio construction when they're putting their own portfolios together.
You're right. That's a very, very good nuance. So we come back to this. How does it fit in the portfolio? Just some quick data points. I presume a lot of our attendees may know the answer, but just let's put it out there. What is the annual expense ratio on both of these securities? Simeon, NOBL, the S&P version, and then EFAD, the EAFE version that you guys are marketing.
Sure. The on EFAD, the net expense ratio is 50 basis points, and on NOBL, the net expense ratio is 35 basis points.
Yeah, and where I'm going with this is, and Raina, you touched on this with one of your early slides. Where's the role of active here? I mean, this sounds like there's all kinds of enhanced beta ways of accessing even the dividend universe, and I want to get into that in a moment more with you, Raina. But what role does active have in all this proliferation of smart beta? And this is a particularly salient and granular aspect of my question. But I'm thinking 50 basis points, 35 basis points. Why even bother with an active manager? Because I'm going to get some what I want here in a very disciplined way. Raina, do you want to take a crack at that one, please?
Sure. So I think, I don't think the discussion is really using these indexes to replace the active space. I think these indexes, as I mentioned before, they found their sweet spot between passive and active, but they are instruments for investors to understand and realize that, okay, well, if I want to get this dividend growth premium out there and I can get it through this ETF, is there an active manager out there who can give me something more? And in fact, if that active manager does have the skill set to reap even higher returns, then he's doing his job really well, and it's great. But then again, if the active manager is giving you pretty much the same returns, as opposed to what this ETF is offering, and you're also paying low fees for this ETF, then that's a choice you have to make. But I don't think people should just blindly use smart beta to kind of replace the active management space. I think it should be a conscious, well-studied decision before that happens.
Jimmy, do you want to take a crack at that? You guys call yourselves the alternative ETF company, and I'm not serving up a softball question, but it's serious. It's kind of a philosophical question. There's a lot of downward pressure on prices, partly now because of smart beta. What's your perception there? You guys are carving out all kinds of interesting little niches in the fund universe. What's the place for active in your judgment at this point in time?
Well, here's a good example. So, first again, these factor-based approaches are, as Raina indicated, sort of a really important and interesting spot that's sort of in between classic passive market cap weighted investing and a active discretionary mandate. So a lot of people will find that to be incredibly appealing on its face, and they may either wholesale or in a majority fashion either abandon a market cap weighted approach or an active approach. But here's another way also to think of it, and you brought up when you brought up the challenge question of, hey, that Noble index has no banks in it. What if I think banks are going to do well? Well, then you have an interesting option now in portfolio construction. Let us imagine for a minute that you have in your U.S. large cap sleeve, you have a active manager that you have a lot of faith in, and you actually know they're taking a dramatically overweight position in financials for the next year, and you look at your sleeve and your portfolio construction, you say, I kind of trust him narrowly, but it makes me a little nervous. Can I complement that with something that maybe has a little less exposure to financials? So, it becomes an interesting opportunity and a tool for folks to invest in the continuum. You can more directly and effectively complement active managers if that's what you want to do. Some people will replace active management, or some people will replace purely passive active management. So I think it's becoming a real important alternative that helps folks all across the spectrum and gives opportunities for much more nuanced and effective portfolio construction. It's really another arrow in the quiver.
Great, thank you very much. As long as we're talking about financial stocks and the absence of them or what have you, Raina, there's a very interesting question came in from the audience. This is sort of in the back testing kind of frame of reference. If the dividend index invested in 2007, what was the percentage of financial stocks in the index as of that time? Do you have any access to those data to shed some light on how this could shift? You talk about an annual reconstitution, a quarterly rebalancing. What does that look like?
Yeah, so I don't have the exact numbers here for 2007, but there will be, you will get, there will be some companies that will be kicked out that kind of stopped giving dividends. So as Simeon mentioned before, if a company, cuts dividends, and as a result it's not increasing its dividends year on year, it will be removed from the index and will not be in the index again until it starts paying dividends for the last 10 years. So that's going to be a while, basically another 10 years. So that would be, it would give, you would have even a lower weight in financials then.
So one would presume that at 07 there were some banks at least, right, in that index, and at the end of 08 and 09 certainly just poof, all gone kind of thing. Is that fair?
Correct. It was, the U.S., obviously, as we saw, the U.S. banks were largely affected, so that was kind of more pronounced in the U.S. space. But in the international space also, we saw financials suffer quite a bit. But then, that being said, it doesn't mean that there are no financials at all. There are. It's just that they definitely did get kicked out once they stopped, or they cut their dividends, rather.
Right. Now, go ahead, Simeon. I'm sorry.
No, I was just going to mention, I specifically said banks because even in the U.S., a couple of asset managers and insurance companies still made it through while still increasing their dividends. So there is a little bit of financial sector exposure, but as we all know, particularly in the U.S. In fact, the funny thing was, if you remember back then, emerging markets was faring a little better than the developed world for about a year or two there. But
sure. Oh, gosh, I remember it like it's yesterday sometimes. The amazing times we all lived through, for sure. Raina, this is a silly question. I think I know the answer, but I'm setting up for another follow-up. The EAFE index is developed world equities excluding North America, and the exclusion of North America also means Canada's excluded, right?
Yes.
Okay. Now, our benchmark here for the EAFE equivalent here at ETF.com includes Canada. And for the record, I'm kind of going in the weeds, but I know that you can handle this, and I know some of our listeners would probably take interest in this. The portfolio yield of this security, EFAD, is actually lower than our benchmark, which again does include Canada. So it's a bit of an apples and oranges thing. But the question I wanted to cook up here is, should investors expect yield here? And if so, when? Or, conversely, is dividend growth more of a stock selection signal? And if so, why not wait by the signal rather than that equal weight? So it's really about the dividend yield. Is that making sense to you?
Yeah, so I think the both stories kind of play in here. So dividend yield is important. So you are getting some sort of it is when we compare it to our benchmark, which excludes Canada, the dividend yield is higher than the benchmark, and probably the reason you're getting for Canadian banks, which actually kind of fared the crisis better than most banks across the globe, given they were pretty conservative to begin with. So I'm not surprised that that dividend yield is actually higher. But in terms of the story, it is stock selection, but then that stock selection universe is kind of capturing your price performance driven by dividend growth. So there's a dividend yield aspect in it, but there's also a capital appreciation aspect into it. So it's not only just kind of reaping that coupon, on a month-to-month or year-to-year basis. It's also looking forward and trying to capture that capital appreciation.
Right. Now, I suppose if someone had a real obsession about Canada, we're getting back to the Simeon question here of where does it fit into the large cap sleeve, and there are certainly options in the ETF universe to address that shortcoming if you perceive it to be a shortcoming, I presume, right? Simeon, if you want to take a slight crack at this Canada backwater that I'm getting into for a moment.
Yeah, no, I mean, there's no shortage of ways to get Canadian exposure, but I just wanted to follow on to the specific question of yield. And from our perspective, if you were to take a dividend growth strategy and then weight the stocks by dividend yield, you're going to creep back into it some of that interest rate exposure and cyclicality that, the absence of which is one of the nice calling cards of focusing on dividend growth. So, for us, that's one of the key reasons why, we, love partnering with these indices that keep it to a focus on dividend growth and don't, sort of through the back door sneak back in the high yielding factor. Again, you might want that sometimes, but that's a different thing with, concomitant cyclicality to it that is just a little bit of a different thing, and this keeps it much more pure and focused on dividend growth.
Okay. Obviously, we've talked about the overall popularity of dividend-focused strategies. Investors have choices. Simeon, if I have plenty of dividend-paying stocks in my asset allocation mix, why would I want to add, for example, EFAD to the mix? What will it bring if I'm already pretty well covered in that realm?
Well, I think you're going to, if you already have your tactical allocation to international developed stocks, you're going to have to swap something. So that's really the question. In other words, if you happen to be underinvested in international developed markets, then you in effect have room. And by the way, many U.S. Centric investors are. There's lots of studies that show that people's portfolios in the U.S. are way too pointed towards U.S. stocks. And by the way, U.S.-based multinationals statistically are not really a sufficient substitute for really investing in international domiciled companies. So if you're missing it, it's just a great answer to, sort of address a shortcoming in your asset allocation. But if you already have international developed stocks in your portfolio, then it's a question of, what would you swap for this exposure? And again, it gets back to, Raina's observation. You're going to swap it either for, the passive indices where you believe in those factors, outperformance track record, and, and nice defensive properties, or you're going to be swapping it for somebody on the active side, where the fee-conscious aspect and the transparency and the rules-based approach appeals to you. So it really comes back to portfolio construction.
Thank you. As long as we're talking about choices, Raina, let's bring it back into focus from an index creator, index provider perspective. This Dividend Masters index series that we're focusing so intensively on right now, obviously very different than your high dividend yield indexes that you also do at MSCI. Can you shed some light as to compare and contrasting these two dividend focused index families, please?
Sure. So the way we kind of see, both these indexes, we kind of see them kind of fulfilling different purposes. So the high dividend yield index that we have actually, as far as I'm concerned, actually kind of gives you that current supplemental income, which, and it's not what the Dividend Masters is trying to capture, which is, the capital appreciation looking forward. So it's a great index or a great strategy to have to kind of supplement your portfolio with, with just stable, consistent income. And, our high dividend yield index actually, in fact, does a really good job of capturing such high dividend paying stocks. So if you look at our current yield on the high dividend EAFE high dividend yield index, it's about 5%, which is pretty high compared to either the parent or the Dividend Master. So even in an environment where rates are going up, it's still a pretty attractive opportunity, and so I would think that people would still be invested in it. And of course, there are some other high dividend paying stocks that are not as high yielding, but what our high dividend yield index does is really capture stocks that are at least more than 30% higher in terms of dividend yield versus the parent. So it's really capturing that bottom cream of high dividend paying stocks. And for the Dividend Masters, I think it's a great strategy to kind of get that, capital appreciation going forward, especially with our indexes in the international arena, which is kind of hard to come by.
Okay. Now, with regards to sector tilts, you talked about that in one of your slides. I chimed in with the consumer segments. We also, looking at these funds at ETF.com, we also see them as really relatively low beta. This is the case of NOBL as well as EFAD. So are these defensive plays? This may well be a simian question, but if you want to take a crack at it as well, Raina, please do. Again, are both of these strategies essentially very defensive in nature? Is that a way to think about them in terms of portfolio construction?
So I'll take a quick crack at it, and then Simeon, I'm sure, Simeon, please feel free to add. But what Simeon mentioned earlier is that actually the tracking error of these strategies to the parent is pretty low. So in a sense, it's kind of tracking what the underlying benchmark, in this case, EAFE. And so what we really see is that with such indexes, it does offer a lower risk. For example, in both cases, like the Dividend Masters and the EM and the EAFE Dividend Masters, it does offer us a lower risk. So it is, in a sense, a little more defensive play, but at the same time, I wouldn't call it a very defensive strategy. I think there are more defensive strategies out there, just in terms of risk and the kind of return you're getting. So this, I would say, kind of would fall somewhere in the middle between being a completely pure defensive play versus just a market cap bet on that specific underlying index.
Yeah, no, I would entirely agree with Ryan on this. This is these are not supremely defensive strategies. You know, the outperformance that you get is a little bit of outperformance in up markets, a little bit of outperformance in down markets, and that compounds really nicely over time. But, you know, if you have, you know, very specific views, if you think there's a wild, raging bull market and you want to have a massively high beta portfolio, this is not it. And if you think everything's going to hell in a handbasket and you want to have an extremely low beta portfolio, this is not it. This is just a really great evergreen strategy that's going to have relatively non-cyclical outperformance, shall we say.
Okay, now I think we're going to wrap it up after this question, but this is a good one. Now, this is an enhanced beta fund, a smart beta fund. I'll use the term that is on everyone's lips. Any particular reason, Raina, why equal weighting was chosen as the way to present this sliver of the investment universe as opposed to market cap weighting?
Sure. So equal weighted, you know, we looked at both scenarios, and equal weighted kind of gives kind of the mid cap segment a little more opportunity. So in fact, it's kind of agnostic to your market cap weight, and it's kind of giving every security a fair shot in that sense. And it is kind of avoiding some sort of top heavy stuff that we might see in some of you know, in some of the market cap weighted indexes. And also just in terms of performance, the Dividend Masters equal weighted methodology does show a strikingly higher outperformance than the market cap weighted. And you know, we do think that comes from giving the mid cap stocks, which are the smaller cap stocks in this case, that opportunity, and they are the ones that kind of consistently grow and keep increasing their dividends year over year.
Okay, that's great. There was one more that came to my mind here, Raina. The sector tilt, does that change in any predictable or appreciable way over time? Obviously, we talked about financials or banks rather at length earlier, but can you make any generalizations about ongoing sector tilts or shifts in slightly different economic environments as you put this index series together?
I think, you know, the good thing about these indexes is actually your sectors kind of will remain more or less similar, and that's also largely driven by, you know, there are only 50 stocks in the index, so you're really capturing the dividend growers, and what we're trying to really capture is the dividend growers for a particular region, in this case EAFE, as opposed to trying to capture dividend growers in a particular sector. Now, as a result of that selection, that, you know, you do have certain sector biases. So, for example, you will see a few more stable sectors kind of dominate in general, because the chances of them cutting their dividends is lower than more of the cyclical sectors. So which is where, you know, the whole thing comes in, that this is a semi-defensive strategy, but it's not a purely defensive strategy. At the same time, it's not a pure beta play. So kind of that kind of plays into the story of what Simeon and I were talking about earlier.
Yeah, and Ollie, just to put a period at the end of that sentence, these strategies are not going to have dramatically high turnover. So the sector composition is going to be, you know, relatively stable because the constituents are going to be relatively stable. You're not going to see 25 of these go in and out in the next at the next reconstitution.
Right. Now, a quick sort of nuts and bolts question for you, Simeon. Since these are large cap securities in well-traveled areas of the investment universe, I presume in terms of liquidity and tradability, this is a pretty, these two securities that you market are pretty reliable, right? This is not where you have to source liquidity religiously before you make a trade, I presume. Yes?
No, you really can't get any simpler than this. And you know, the one thing I would say is just for folks out there who are, you know, going to be trading or thinking about, you know, trading any ETF or these ETFs in you know, size, they should be working with their capital markets partners, the desk in their various institutions, because of course the create-redeem process is the way that you make sure that you always can get executed at the, you know, taking advantage of the liquidity that you appropriately noted, Ollie.
Okay, great. On that note, we'll call it a day. Simeon and Raina, thank you for being my guest, and thanks for the audience for attending and asking some good questions. Again, this deck will be available to all of you in 24 to 48 hours. On that note, on behalf of my guests and all my colleagues here at ETF.com, I'm Ollie Ludwig, wishing you all a pleasant afternoon.